Good morning and welcome. Patriot Radio News Hour. Joe and Jason on this hump day. And it is also Fed Day. Obviously, after we are off the air, we'll get all the fireworks of are they raising? Are they going to announce a pause? What exactly are they going to say about the banks? And I'll tell you this, none of it matters. They've already, and I say that because they've already made the mistakes. They've already made the errors. And now we are forced to live with it. 15 years of zero, unlimited money printing. Everybody that had an IQ higher than room temperature knew this was going to happen. And it's the perfect storm because we've got the great Patsy, Jay Powell. Of course, we got Joe Biden, right? And again, the digital currency is what is going to come out of all of this. And unfortunately, before that comes, it's going to be a lot more pain for the American citizenry. 800-951-0592. That is our toll-free number. You know what we do. Gold and silver, the physical delivery of it. If you want less pain, that's what you need to do. You need to get that gold and silver put away. AllAmericanGold.com is the website. And Jason, we saw a rally in gold and silver yesterday. It's rallying again today. But the big fireworks will come after we get the release of the Fed statement, which will then be followed with the press conference with Jay Powell. Right now, the consensus is they will raise 1/4 of a point, which will put the Fed's funds rate between 5 and 5 1/4, and then announce that they are going to pause. Now, the thing that really could send gold to the stratosphere, let's assume that that is what happens. If he says the word extended pause, then all of a sudden we could really see some fireworks in the gold market, Jason. I don't know that he will. I still think he'll try to say rates are going to stay higher for longer. In other words, saying, yeah, we're pausing, and we may pause for a while, but it doesn't mean we're cutting.
I think we're in a situation, Joe, where it's almost anything they do now will make gold go up. I mean, with all the rate hikes of 2022, gold did come down a little bit. I think got down to, $16.20 last year. And but with all of those rate hikes, gold still is staying strong all during 2022 and then now into 2023. So I don't see what kind of move doesn't make gold continue to go up. I think gold is primed just to continue to slowly grind it upwards until there's a bigger emergency on the horizon. And that'd probably be some more banks closing down, Joe.
Well, and again, we got more details on that. Of course, yesterday we realized, whoops, okay, the crisis isn't over. Now we have former Fed governors, Kaplan being the latest, saying, hey, this isn't over. I think a lot of this now we're going to really start to focus in on how bad is the debt getting. The debt ceiling now, we're 4 weeks away from hitting the debt ceiling. So we're somehow they're gonna raise it. What they do, who knows, but it'll give us a better picture of how bad the problem is getting. In other words, how big is the national debt going to be moving forward? And at the same time, commercial real estate, I think, is going to be that next domino. How bad does that get will tell us how many more banks are going to have trouble. And, of course, jobs. That's going to be the other big one. Now, we got ADP out today, and this one gets a little volatile. They had a bigger number today, just under 300,000 jobs created. But here was the interesting in their report. All of a sudden, the low-end jobs just skyrocketed. They call it leisure, hospitality. It's almost like everybody was like, I better get my job while I can or get this other job while I can. Wages did cool off in that report. And again, that kind of made sense because it looked like most of the jobs were going to be at the lower end of the pay scale. But we'll be really focused in on tomorrow and Friday. I think Friday we'll see the lowest job creation number yet. And so we'll see what jobless claims do tomorrow. And then, of course, we'll start watching next inflation.
Yeah, Joe, I agree with all of that. I mean, here we are. There's not a whole lot to disagree about when it comes to what the Fed is doing and the economic situation as it sits. If you understand it the way that we do, there's not a whole lot for us to disagree. We do disagree on some of our prognostication, our predictions and stuff. But right now, I mean, it looks like they're going to raise the rates again. And then, as you said, they're sort of starting to put the word pause in there. So I guess we'll see. We'll see if they pause. I think you're correct. They're going to pause. Just to say this, I would not be surprised if they rose them again. I wouldn't be. We'll just see what happens in the next 6 weeks, I guess.
Yeah, we'll watch this all play out here. But the one thing I think you're right, we do agree on is there's really not a lot where it would be like, oh, that's going to be bad for gold. So, when we say gold, by the way, when I say gold, silver's with gold. I tell the story all the time. Gold and silver are brothers. Yeah, sometimes, right, they have a little fight or they get separated, but at the end of the day, family runs with family, and if one's running, the other one's going to run with it. 800-951-0592. Joe and Jason coming right back. Eight 800-951-0592. Joe and Jason, Patriot Radio News Hour, Fed Day Wednesday. A quick look here at the markets. The Dow is down 75. The S&P's down 3. The Nasdaq's up 26. Gold's up 9. 2032. That is the June contract. That is the most current contract. There is no May contract for the COMEX. And I want to say spot price is probably somewhere around 2025. But right now, June gold 2032 up 9 and change. Silver's up a dozen, 25.52. Listen, we still have some of those dimes and quarters. Get them. Believe me, it is not going to get less expensive. Rolls of silver quarters at 270. Rolls of silver dimes at 135. And I know you got to be sick of me saying it, but if you want to pay more, just wait. And speaking of waiting, if you're tired of dealing with what is going on with Wall Street, check out our friends over at Y-Refi, right? This is somewhere else that you can park some money, not correlated to Wall Street. You can get up to 10.25% return. It doesn't care that the Fed has made a policy mistake. It doesn't care that Jay Powell's a patsy. It doesn't care that more banks are going to go under. Check it out. InvestYRefi.com. That is the word invest, the letter Y, REFY.com, or call 888-Y-REFI-24. That's 888-Y-REFI-24. Remember, you got to have at least 50,000. But here's the good part. You can use an existing IRA if you want to get that done as well. But Jason, we're now getting ex-Fed Reserve governors coming out and saying, hey, the Fed has made a mistake here. The latest coming out of former Dallas Fed President Robert Kaplan. He said, now, here's the thing that gets really interesting, because they're going to try to use it, and we're really going to be listening. I would prefer, this is Robert Kaplan, I would prefer to do what's called a hawkish pause. Yes, this is a hawkish pause, or remember we talked in the first time, maybe they're going to say extended pause, right? It's going to be very interesting, the words they use to go along with the pause. But he is actually saying the Fed should not raise rates today. Now, that's an option we haven't talked about. That would a no rate hike today. I would be shocked if gold wasn't at an all-time high today. I don't think that's likely. But I told you 6 weeks ago it was a mistake to raise. But this is how clueless and spineless Jay Powell is. But he would say not to raise, that we are in a tightening stance, because I actually think, this is, again, former Fed Governor Robert Kaplan. He was the Dallas Fed. I actually think the banking situation may be well more serious than we currently understand. And Jason, I think this is really the cusp of it. They don't, listen, I get it. They want calm, right? Hey, Wall Street's still 30. The Dow's still 33,000. Nobody panic. I'm telling you right now, the banking crisis isn't over. Most of these banks, and listen, I gave you the data yesterday. Look it up for yourself. Half of the banks right now, and again, I think the Fed makes it worse today when they raise rates, is technically insolvent. In other words, their assets are less than what their liabilities are, and by Jason, to the tune of $2 trillion, and I think every day it gets a little worse, right? Every day, well, how about today? Tuesday morning. You know the store Tuesday morning? They're liquidating, shutting them all down. So let's see, that's Bed Bath & Beyond shutting it all down. Tuesday morning, shutting it all down. Jenny Craig shutting it all down. Jason, it's starting to become a theme.
Yeah, I'm starting to see a lot more stores. I think it was just last month. We came up with a list just here in Colorado of the different stores closing down multiple locations. You know, Bed Bath & Beyond being one of them, one that you've been keeping your eye on, Joe, because they've been closing down a lot of those stores. And unfortunately for these stores, there's a lot of factors going against them, and one being that everything's moving into a mail order market on top of all the economic stress, Joe.
Yeah, and the other part is these debts got to get refinanced. And here's the bottom line. It's not worth what it was, and the rates are much higher now. So it's a double whammy. It just doesn't make sense. Hey, for a lot of these, what I'll call the marginal retailers, they're done. Bed Bath & Beyond, marginal retailer. Tuesday morning, marginal retailer. They're done because, we can't refi the debt. Nobody's going to loan it, right? First of all, we can't get what we owe on the buildings. B, the interest rate we've got to pay, we can't actually, even if we could get what we owed on the building, we can't actually afford to make that monthly payment because we don't have that kind of cash laying around. And Kaplan, listen, this guy did not pull any punches, guys. It is more important to be able to sustain the current rate for an extended period of time. In other words, we cannot lower rates. Listen, they all know. I'm going to tell you right. I'm going to let you in on a big little secret that isn't a secret. Once again, you want to listen to Jay Powell, or do you want to listen to me and Jason? Jason, I've been telling you for 2 years now. Actually, since they started that transitory nonsense. A, we told you it wasn't transitory. B, we told you this was going to be like a double Great Depression, where we have the economy, GDP, right, negative growth, but yet we still have high prices, right? This is not what they that they want, and this is what Kaplan's talking about. Listen, you get in this one more hike, you're going to cause more damage that potentially may force us to have to lower rates when we know we shouldn't. And you know what, Jason? It doesn't matter. It doesn't matter. It's all, that ship has sailed already.
You know, if they were going to raise it a full point or 2 points, right, later today, I could see a lot of chaos because things are just so tightly wound, right? But even for as tightly wound as everything is, it's going to not be good, but it's not going to be anything more tremendously worse than it already is. So they'll raise the quarter point. If they were going to do 4 or 5 quarter point raises over the rest of this year, then I could see a lot more angst and stress. But it really does feel like they want to get this thing to where they pause for the rest of the year, and then just coincidentally, there's a lot of rate drops around election seasons. You know, if you look at the election seasons, there's a lot of those times where they lower the rates, right? I mean, you can blame it on whatever you want. Like the last time we had the COVID nightmare during an election cycle, but they did lower the rates right before. So the rates will be lowered before the election next year. For whatever reason, they got to make sure that they can have a printing power going into that election. But it's they will pause, Joe. So I guess this is about as good a time as any after today's rate hike.
Yeah, and he made some more disturbing comments, particularly when it comes to banks, that bank stocks have been marked down solely because of their overinvestment in U.S. Treasuries. And remember now, these are losses now. And here's the thing. Why are they overinvested in Treasuries? Well, nobody else is buying them. I mean, let's not kid ourselves. The rest of the world is not lining up to buy U.S. Treasuries. Sorry. They're not. Matter of fact, I mean, there's so much going on. Yesterday's announcement, I got really took off yesterday. When the entire Middle East now says we're BRIC nations, right? We're applying for full membership into BRICS. That is a significant blow to the treasury markets, and it's going to continue. And what ends up happening, well, these banks and the Fed and everybody else, they're the ones left holding the bag, Jason. And I'll be honest, because of idiotic policies, they just had to have Dow 33,000. Right? Would it have been horrible if the Dow was only 20,000? Yeah, I know. All these homes wouldn't be worth, they'd only be worth half of what they are today. We wouldn't have inflation, right? We wouldn't be having a banking crisis right now. But Jason, they just needed their precious little stock market to go up because, well, like any good Ponzi scheme, right? They gotta have more debt.
They have to have more. It's a debt money system. The money is only created when debt is created. That's something that people generally don't understand, which is for there to be money in the current monetary system we have, that has to be borrowed into existence. And after it's borrowed into existence, this is where all the debt comes from, because we have to pay interest on that money that's borrowed into existence. We could just simply have the Treasury just print the money. We could just cut out the private central bank and at least have our own debt inside ourselves. Well, actually, there wouldn't be any debt. If the Treasury just printed it, it would just be there. They'd print too much. There'd be inflation. They would not print enough. There'd be deflation. And then we could vote these guys into office that would actually make smart decisions on printing the money. But I guess from what the Fed has told everybody, it's just too complex. It's too hard to understand, Joe, for the average guy. Let us steal from you and just don't say nothing. Shut up and sit down.
Yeah. So unfortunately, Kaplan started naming names yesterday. Obviously, Western Alliance and PacWest. And these are easy calls, guys. Sorry. They just have huge exposures to commercial real estate. But he went on and said M&T and East West Bancorp. These are also relatively large regional banks. They have even more exposure to the commercial real estate issues. Then they said other smaller regional banks that have high exposure. The regional bank index, and talking about what the exposure levels are. These regional banks, obviously it's a problem, but Jason, there's plenty of exposure in the smaller banks as well. So I think we're going to really see a lot more of these dominoes have to fall, especially with what's happening in commercial real estate. And now that all of a sudden it seems like here come the layoff notices, right? Well, layoff notices usually means what? Well, we got less people at corporate, right? We need less space, not more space.
Yeah, and the commercial real estate and the layoffs. These are all the things you've been calling for. It's just happening slower. People think of a market crash, it's supposed to all be in one day. These things happen over weeks, months, and even years. And it's just for hindsight, it's pretty easy just to group a bunch of years into it, right, Joe? I mean, it was 2008, the housing crash, but it really was before that and quite a bit after that when the whole thing was happening.
Patriot Radio News Hour. We'll be back right after the break.